Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Mitchell, welcome back to the Australian Investors Podcast.
Thank you, Owen.
We are talking about 10 truths of investing for episode 2 of our mini-series. And today we're going to talk about, I guess, like I referred to in the first episode, the goalposts and kind of the way we put together our belief system and our philosophy at Rask and what that means for the way we invest and what other people can learn from that. If people want to get in contact with you, there is a link in the show notes. They can book in a call and learn more about Rask Invest, which is our investment service.
Absolutely. And look, just shoot me an email, Mitchell at rask.com.au. You'll get me.
Easy. In the first episode of this series, we talked about Morgan Housel's book, who was a former guest on the show. Very delighted to have that happen. But Morgan's first book is The Psychology of Money. And I did reference it in the first episode. So I'm going to bring it up here and ask you, why did you think that was such a good book?
So all through my funds management career, my role has been very client-focused. I've been the person who I told the story of sitting down at a kitchen table. It was actually at a beautiful house in Brighton, getting a dressing down from a client for something that the analyst team had done, a decision they'd made. But I mean, at the end of the day, I was the one facing the client. And it was very apparent to me that their own psychological makeup really determined the outcome of their investments. So people's investments with the funds management businesses that I've been with in the past had varied. Their own outcomes, they'd all been invested in the same funds, but their outcomes would vary so much to how they react to certain events. And so just like with Rask Invest, these other businesses that I was at, they were transparent. You could see each individual holding, and people might fixate on the one that was down, or people might they can't see the forest for the trees, so to speak. And so how they reacted was just as important as what the analyst team actually did.
Yeah. And
so that led me down a pathway of really digging into behavioral economics. Morgan Housel, I think me and you listen to a lot of the same podcasts.
Probably.
And so I kept on hearing about his book and I thought, I've got to get this. But I actually stumbled across a study that actually put it, before I got to the Housel book, the Housel book puts it into really great practical examples of what you can do and what you're going to experience as an investor, like the emotions that you're going to experience. But I found an actual study that put it into hard numbers, the cost to investors. And it's a research institute out of the US called Dalbar. And they've been doing this study for 30-odd years where they actually look at the returns that the clients of these mutual funds in the US have actually received. So there's plenty of reports out there saying, how many managed funds have underperformed the market and how many in the average benchmarks and yada, yada, yada. You can see those. There's plenty of those. And they get the headlines. But the bigger story to me is what ends up in the investor's pocket at the end of the day. Because I know here in Australia, my career has been dealing with a lot of SMSF investors and sitting down with families who rely on their portfolio to fund their lifestyle. And so if they bugger that up, then, they might not be going on holiday this year.
Yeah.
They, might be downgrading their lifestyle significantly, causing themselves a whole heap of stress, causing the family stress. These are the real life outcomes. And so the Dalbar study looks into the different returns, the returns of investors to the actual funds that they're invested in. And I'm plucking these numbers out of the air. I think it's roughly 2.83% average underperformance of the fund that these people are in. So not only do you have managed funds on average underperforming the industry benchmarks, you're compounding that with investors on average getting 3% per annum less than that.
Right.
So when you extrapolate that over a 5, 10, 15, 20-year period, that's so significant. And so the factors that these guys continuously find that results in this significant underperformance are the psychological factors. So like confidence bias. So people, when, everyone's patting themselves on the back for the stock market going up and and they might abandon their plan, and instead of tipping in $200 a month or $1,000 a month, whatever it is, they might just get this nest egg and go bang. And all of a sudden they're overconfident, they've thrown their plan away, and they're investing at the top of the market with a big chunk of cash because they've got that confidence bias, and they've got the recency bias as well of extrapolating those good times. And so inevitably we know markets are cyclical. So what goes up must come down. And so when everyone's patting each other on the back, to me, that's always a sign of, maybe I should be a bit cautious here. And then on the inverse of that, when things pull back, they found that investors were more, instead of, what I know a lot of Rask, the community do, which is they are really quite eager to jump in, the average person on the street gets quite fearful and pulls out.
Yeah.
Or takes some off the table, if not all. And so that is how you end up in this underperformance cycle, really actually at the end of the day impacting your wealth in your own pocket. Sorry, that's a really long-winded way of how I got to Morgan Housel and that Psychology of Money book. One of the best quotes, I think, from that Psychology of Money book from Morgan Housel was he said, he was in a position where he said, I can afford not to be the best investor in the world. I can't afford to be the worst. That really stuck out to me.
That's great. I didn't remember that quote from the book. So that's wonderful. And I was reminded of when you were referencing the Dalbar report just now that when we put it in the owner's manual, I was trying to think of like the behavioral biases or some phrases that people might be familiar with. But Charlie Munger had this great saying, which was, envy is the only one of the 7 deadly sins you'll never get any pleasure from. And so on the way up, people get envious, they pile in, they see what someone else is doing, it looks great. All of a sudden they're questioning their passive management or they're questioning their stock selection. And on the way down, we know from the works of the late Kahneman and Tversky that loss aversion bias kicks in. And then when loss aversion bias is kicking in, which is the fear of loss is greater than the joy of pain, when that's kicking in at the same time, people are fear-mongering in the news or in your favorite website or on the in the newspaper or media. But when that kicks in, that comes into our flight or fight instinct.
Yeah, it's natural too.
Yeah, and most people are in the flight instinct because we're behaviorally and evolutionary, we're predisposed to running away from danger. And so the easiest thing to do is to sell at exactly the wrong time. So this is why finance in almost every way is constantly like tinkering against you. It's constantly pitted against your behavior. And that's exactly why we designed the Rask community the way we did, but also the Rask Invest product is built the way it's built. So, Mitch, there are around about 10. They'll probably give or take over the years. But they've remained pretty much the same.
I'd seen these written down in this format for the first time in something that you've just alluded to, which is the owner's manual that you're putting together for Rask Invest investors.
Yep.
So let's get into them and you tell me a bit about them. I like the first one, it's just pretty blunt. Capitalism works.
Yeah. So I came up with this list of like, what are the 10 truths of investing? There's a wonderful Australian podcaster from the United States. He's Australian, but he's living in the United States as far as I'm aware, named Simon Hill. And he talks about, he's an incredibly brilliant researcher on health and well-being. And he, for many years, kind of didn't do anything. He didn't put out anything that would be seen to be like him coming out with a solution to a dieting strategy or something like this. But eventually came out with something, and he had these truths. And what he found after years of academic research, industry research, reading countless studies, and he came out with these truths. And I thought, well, maybe we can come out with something like this and for investing. And at the time, this was going back quite a few years, when capitalism, and in many instances, it's still seen as a dirty word. And capitalism can go wrong. We've seen that in many ways, like in pharma in the United States, for a good example. But capitalism with bumper bars is, in my opinion, the thing that works. And the idea of capitalism is something that basically goes into our kind of instinct and how we have developed as a democracy, which is that if someone takes an extraordinary amount of risk and they create value for society in doing that, they should be rewarded. And while you may not think it, when someone starts a cafe, they are taking a significant amount of risk, because we all know how many cafes come and go. And sure, they might charge more for a cup of coffee than you could make at home, but they're bringing you value. You don't have to buy it. You could go home and have an Nescafe if you want to, but most people don't. And so if someone does take that amount of risk, they should be rewarded. And that is effectively what capitalism does. And over time, if someone that runs that cafe is doing well enough, if they're getting so rewarded, what would happen in a wonderful democracy and a place that has property rights like Australia and many other countries throughout the world is that another cafe would pop up and cause competition. And what that would do for the consumer is either bring down prices or force one of them to produce a better coffee, which pushes society forward. And so when people say to me that capitalism is a bad thing, I think it couldn't be further from the truth. Imagine if you go to university and you study hard for 10 years and someone doesn't go to university and doesn't do any study, even though they had exactly the same opportunities as you. Who should be paid more when they get their job? Probably the person who takes the risk, because it was a sacrifice that they had to make. And so this is capitalism at work, even in a non-commercial way. This is the very framework in which we live and which societies thrive. And I believe that the stock market is one of the best ways to capture capitalism in the wild, in that you don't need to take all of the risk. You risk your money, but you don't have to take the blood, sweat, and tears that go into starting a business and potentially lose all of that for many years. You can buy an index fund. You can invest in the stock market. And that's the reason why I think capitalism works and why I think shareholders who support the people who take the risk are rewarded. It's a very philosophical thing, but it sets the groundwork for basically everything that comes next.
And speaking of coming next, it would not be a 10 truths of investing list if you didn't have a bit of Buffett and Munger in there.
Yes. So this is point number 2. Good lead in, Mitch. I really appreciate that. So Warren Buffett has many wonderful quotes. Some of them he probably didn't even say, but one that I'm certain he did. And you can go back and look at all the letters and all the AGMs and these types of things of Berkshire. But Buffett once said that the stock market is a vehicle for transferring wealth from the impatient to the patient. And there are numerous different studies that would back this up. But in effect, what he's saying is that a lot of people are myopic or short-term focused, particularly with money, particularly just in general. There's a lot of biases.
I remember talking to a lot of fund managers in the past and my mates who are analysts and whatnot, and listening to the archives of the Australian Investors podcast. And if you listen to basically almost every professional who follows the value investing approach, essentially, who's been kind of ingrained with that Buffett style, and there's lots of them in the back catalogue of the Australian Investors podcast. You ask them what their edge is, because edge is a big thing in investing. I reckon every single one of them will tell you their time frame.
Yeah.
Investing for the long term.
Yeah.
Like being able to see through this earning season.
Yeah.
And wanting to invest in businesses that have a 5-year vision or a 10-year vision.
I thought it was my duty to bring guests to the show that we're not institutionalized fund managers, because I wanted people that listen to the Australian Investors podcast or any of the Rask podcasts to see finance for what it really is. And a lot of the finance industry is still dominated by the types of people who do not appear on our show, which is the people who are investing money for pension funds or investing money for faceless groups. And those people, ironically, even though they would tell you the same story, there are various studies that show the average time horizon or the average stock holding for many of those funds is around about 7 months. So if you're a long-term investor, in my opinion, short-term for me is 3 years. If you're an ETF investor, short-term can probably be 5 or 10 years because you know it's still going to be around. Stocks, you obviously need to be a bit more agile. But there are studies that show that on the broad portfolio side, you don't get that hockey stick-like compounding until many years down the track. Anyone can see that. But even on this individual stock portfolio level,
you can see how the study on when Buffett made most of his wealth.
Yeah.
Or came after he was
99.7% came after 60.
Yeah.
Yeah. And on our property podcast, you'll hear Chris, Amy and Pete tell you that it's not about how many properties you can buy. It's about finding the right one and holding on. And these rules pervade basically every part of finance. And Warren talked about it in a way that's for the stock market, but that is in essence one of the best quotes I think he's ever had.
Next one, third one. And this might go slightly against the property thing that you've just mentioned about it's not about accumulating, but wealth creation can be summed up in 2 words. What are they, Owen?
Accumulate assets, yes. So now, sure, some property investors may have 10 or 15 properties in their portfolio, probably 10 or 15 mortgages as well. But you talk to any of those guys, they'll tell you the same thing. Accumulate assets is a lesson that most people will be familiar with from the Robert Kiyosaki book, Rich Dad, Poor Dad. But in financial jargon, basically you have financial statements in a company's annual report. And in that report, you will see things like a balance sheet, cash flow statement, an income statement, or a profit and loss. That's what it's also called. And there's a fourth one that no one ever talks about because it's basically useless, which is the statement of changes of equity. For the accountants in the room, you know what I'm talking about. And basically what most people know is they know their personal income statement. They know how much they earn in salary. They know what their monthly expenses are, how much you spend on Netflix. Yes, YouTube Premium did just go up in price this month, that kind of a thing, right? But a lot of people don't really pay much attention to their balance sheet. And in a balance sheet, that's basically where your net worth comes from. It's what your income statement puts on your balance sheet, which is most important. And a lot of people spend time finding and purchasing assets that aren't really assets. So what I mean by that is they're things like cars and vehicles that depreciate. And if you were to create your own financial statement, you would realize that a lot of your income goes to these quasi-assets that are actually liabilities, things like a TV that depreciates, things like a car that depreciates. The only really good debt you get is from property. But I think where this point comes from, and the reason why it's really high up on my list, is that there is so much convoluted, obfuscated, bizarre finance jargon. Even those words I just used are bizarre, frankly. But they're just words. If you go back to the George S. Clason book from I think it was 1927, I could be wrong on the date, but the book, The Richest Man in Babylon, bizarre book. In the first chapter, you can get past that one, go straight to chapter 2. This was a book that basically set the groundwork for everyone, and the whole idea was that it was based on stones and things that were written thousands of years ago, right? These rules of gold. And, it's invest wisely, save a little bit of your gold, repay your friends and your family, and really simple tenets that have, according to this book, perhaps thousands of years old. And it all comes back to this one idea that you should put as many different things in your asset column as you can and avoid putting things in your liabilities column. And I think if you ever get stuck, if you get bored of a Rask podcast, just remember that that's your job.
Fair enough. And so next one, speaking of your job, and fewer investment decisions often result in better decisions. So you're referring to high conviction and concentration. And I know in the last podcast in this series, we spoke about how you're investing currently. And I think this is an approach that you're personally taking, those fewer investment decisions with higher conviction, speaking about that core and satellite approach that you're taking and focusing much more on that core.
Yeah, and this rule can apply to both core and satellite. The wonderful thing about investing and dollar cost averaging is once you set up a good portfolio, you can add to it regularly, assuming that that's what you want to do. But this actually comes back to, while this might seem intuitive, it also is empirically tested. So while it makes sense that you would just make a few good investments because it would help you avoid the behavioral trap of overtrading. In the last point or the point before that, we talked about how a lot of the investors that we've had on our podcasts would say time is their advantage, but they would also say, when I asked that last question of like, if you could go back in time and change one thing or tell yourself one thing about investing, finance, or business, what would it be? You've probably heard me say that thing before. The answer is often start now or start earlier, right? Is a time advantage. But if we go back to the way we've built the podcast over many years, is I've had to be very, very careful about who comes on our podcasts. And a lot of people, you will realize that that's a common theme. And it's a common theme because we've not let certain people on the show. The people that we've not let on the show are people who are more often than not trading focused. And people would often would say to me, particularly in the early days, they'd be like, oh, you should chat to this trader, you should chat to this person. None of them, as far as I know, are still in business. And in the professional investing world, they don't exist. They're not, because their just strategies don't work. And so we've manicured the podcast over so long to help people understand what is important, that is long-term investing, because it works. And so when you think about this, you don't need to go out and constantly trade. Morgan Housel's other lovely, it's actually a headline, not so much a quote, was 99% of long-term investing is doing nothing. The other 1% changes your life. And I love that because it just puts it in perspective. If you took that headline of Morgan's and you put it into practice, you'd probably only trade 4 times a year. And when I was at Zenith Investment Partners, we did a study of fund managers, of active fund managers. And what we found is that fund managers who had fewer than 30 stocks in a portfolio tended to outperform the fund managers who had more than 30 stocks.
So making less decisions.
Making fewer decisions. But most of them can't do that because if they invest that way, they'll have too much volatility and the financial advisors who invest with them will not have them in the portfolio. So even though that may be the superior way to invest, they won't do it because their clients, who are the financial advisors, couldn't justify it to their clients, who are the investors at the end of the day. But as Warren Buffett also once said, you can treat investing as a 20-hole punch card. You've only got 20 investments. If you stop and think about it, you would make better decisions.
And so getting on to, I think this is point number 6. Point number 6 and point number 5, diversification is very important for all investors. And this is why we build our portfolios mostly with ETFs.
Yeah, so this is why you can tie the two things together, is you can have fewer investment decisions, but you can still have diversification thanks to ETFs. So you can have, say, 10 different ETFs that each do distinct things, but within them, they're internally diversified. And this is a really important point. Stephen Arnold, who was a prolific active fund manager and I have a lot of respect for and I would invest with, he's come on the show, active investor, and he would often say to us here on the show that even though he had a portfolio of 10 to 15 stocks a lot of the time, those are companies like Nike that have operations all around the world. So while it may only be one stock, it's diversified in that it operates everywhere. And an ETF, by its nature, is diversified, unless you get one of those really weird ones from the United States. We won't go there. So you can have one ETF that gives you exposure to 500 stocks in the case of IVV, one ETF that gives you exposure to 300 stocks in the case of VAS, the Australian Shares Index ETF. And so you can have that through what seems like a pretty narrow portfolio on the surface is actually internally really well diversified. And there are a few points on this, and I'm going to jump the gun here on you, Mitch, and I'm going to bring the next 2 points in.
Please do.
Which is the benefits of extra diversification will rapidly diminish after 10 uncorrelated positions. The next one is less than 5% of companies on the stock market are responsible for all of the stock market's wealth creation over bonds. Let's take those two in tandem. So, everyone knows that diversification has benefits because you can spread your eggs and you don't put them all in one basket. I hate the analogy, but that's the analogy that most people know. The idea is that if we think about property, if you owned 5 houses all on the same street and that street just so happens to be next to a creek that floods, they all face exactly the same risk, which is flooding. But if you took those 5 properties and you put them on different streets in different suburbs, if it floods on that one street, only 1 in 5 is affected. And we have that same effect in investing in the stock market. And typically what we find is that you don't need to be ultra diversified to capture almost all of the benefit. You don't need 2,000 stocks in an ETF. You probably only need a few hundred. So it's not really worth having thousands. It actually can just increase trading costs behind the scenes. But then if we think about diversification from another lens, which is the thing that I don't think enough people talk about, is that when you pick individual stocks, a lot of the research shows, and the Professor Bessenbinder from Arizona University did a lot of work on this, which is that in the stock market overall, only 1 to 5% of stocks actually do better than fixed income over a long period of time. And you think, how does that actually work? It's because the NVIDIAs, the Apples, the Googles, the Microsofts, there might be 5,000 plus stocks, right? But those are the ones we know because those are the ones that do all of the heavy lifting. Now, if we think about diversification, we know that it has risk benefits. It dampens the impact of a flood in your portfolio, right? But it also has the opposite effect of giving you some exposure to all of the companies, such that if you get it wrong and, oh, hey, you thought, I don't know, there was a big theme, like say lithium, right? You thought lithium is the next big thing. It turns out lithium wasn't the next big thing. Fortunately, it was AI or something like this. And because you had an index fund, you had some of that. And so by being diversified, you actually capture growth. And there's a lot of kind of like sub-studies that have been done on the whole diversification thing that show the benefit of diversification is actually not from the risk perspective. It's actually from the upside potential. And that's something that most people miss when it comes to ETFs.
Well, it's just like all of the studies that people have done around market timing.
Yes.
What if you missed the 10 worst days in the market? Where would your portfolio be? Or what if you missed the 10 best days? Your returns have reduced dramatically. So what if you didn't have one of those stocks in your portfolio? So it takes away that risk.
Absolutely does. What if you don't have NVIDIA? What if you don't have the FANG stocks? And the same thing could be said about, say, emerging markets, like Chinese stocks have performed horribly over the last 5 to 10 years. That's obviously because of the government regime in terms of how that's kind of backfired. But there's a case to be made that, it's been bad over the past 10 years. You probably still have some of your portfolio exposed to that, consumer in particular, and the technology companies. But that's another good example of that. And it's interesting that you bring up that study. I really lament that study about there's so many of them and everyone tries
so cherry picking.
Oh, they you could use that study to justify just about anything. But what I've found is that all of those studies that say if you just avoided these 10 days, what they all miss is that those 10 worst days are clustered right next door to the 10 best days. So you end up with being out of the market because you want to avoid them. In doing so, you risk missing some of the best returns of your life. And so it's almost impossible to say that it would have worked. It is impossible.
A mate of mine's got a saying, talking about this, like missing the best days or missing the worst days, et cetera, et cetera. If you're an ETF investor, as we are, you've essentially got one job. That's just hold.
That's the hard part.
That's the hard part. That's what brings us actually to your next one. There are 3 commonly accepted investing edges: behavior, analytical ability, and information. So behavior, that's where the hold comes in.
Yes. Yeah, it does. There's a lot of talk on this podcast and on every podcast about what you should buy. I can almost guarantee anyone that's been investing for more than 5 years will know that the hardest part is actually staying invested. I remember
a lot of people actually tell me the hardest part for them is selling.
Well, that's probably the hardest action.
Yes.
But if you think about the longest time that you have, it is the whole reason we're long-term investors because we let the companies lift for us. It's passive. It's growing in the background. It happens without us having to go and issue a mortgage at Commonwealth Bank will do that while we sleep. That's what we're seeing happen. So the longest period of time that you're exposed to markets is when you're holding. But so much of the time when you come to a podcast, if we did 365 episodes of the Australian Investors Podcast or the Australian Finance Podcast, for most of those days, we'd probably be saying, "Good day, guys. Welcome to the podcast. And today we are holding," and that is just about it.
We have got to launch the Australian Holders Podcast.
The Australian Holders Podcast. Well, that's really it. But the reality is that most of what spins the wheels of our business or most businesses in finance is activity.
Yeah, it's new products. It's
thematic ETFs. It's brokerage fees. It's new share reports.
It's interesting to talk about, but generally, does it add value to your portfolio?
Jason Zweig, and something we didn't include in this podcast, I put this quote at the top of our philosophy page. I'm actually just going to bring it up on my computer, but we put this quote because I won't butcher it, from Jason Zweig, who is, as far as I'm aware, a friend of Morgan Housel's, and he's also a fantastic journalist and a fantastic author in his own right. He says, "I was once asked at a journalism conference how I defined my job. I said, my job is to write the exact same thing between 50 and 100 times a year in such a way that neither my editors nor my readers will ever think I am repeating myself." And basically, he is paid, like most investors are paid, to do the same thing every day of the year.
And luckily for him, now there's ChatGPT.
Well,
he can just put it an auto prompt into ChatGPT to produce that for him and job done.
Well, there you go. I'm not sure it'd be as eloquent as that, but he would definitely get the job done. The last 2 are quite self-explanatory if you understand where this conversation has gone, which is that most people shouldn't invest in individual shares because they lack the time, inclination, and or curiosity. Now, I didn't just make this up. And in fact, I didn't even come up with this. It was a guest on the Australian Investors Podcast, a guy by the name of Curtis Larson from Norse Capital, one of the very first investors. It was a really wet day in Sydney, and I'd just gone across the bridge to Mossman, which is where Curtis and I met up, and it was bucketing down, and he worked in this office because he runs his own money and some friends, that's it. And he sat down with me. He's so generous with his time. We sat in this room that kind of had no insulation on the roof. It was kind of just like in the outhouse, the water was just banging down on the tin, and you could hear it in the background of the podcast if you ever go back and listen to this. And Curtis was a super bright, kind of like a maths whiz, and really active investor, but also incredible in terms of his investing skill set. And he's done a wonderful job, but he just invests for himself, which is fair enough. And he said these exact words to me. He said, people shouldn't invest in individual stocks unless they have the time, inclination, or curiosity. And each of these ingredients are really important. Most people don't have the time to invest for themselves.
No, I do not. I don't think I own any individual stocks. I have to actually think about it then. No, unless there's a DRP that's been running that I've completely forgotten about. No, I don't think I do. And that's because even after being in this industry for all these years, and a lot of my friends are analysts, and they tell me about all the wonderful companies that they're investing in, I talk to investors all day, every single day. And I know that these analysts, my mates who are analysts, they are devoting their work time, their after hours time to researching companies, to put together a portfolio of, for them, that analysts in their own accounts generally run pretty concentrated portfolios.
They know what's good.
They generally speaking, about a dozen, maybe 10.
Yeah.
But even they're only getting 5 out of 10 right.
Yeah.
Or 6 out of 10 right. The good ones might get 6 out of 10 right.
Yeah.
Who the hell am I to sit there and think that I can get out my iPhone on the tram home, look through a couple, ComSec, and pick out a couple of stocks?
Yeah.
It's just not. I'm just absolutely kidding myself and completely devaluing what these guys do. And so I realized pretty quickly that it was a surefire way for me to lose money. Yeah, and I can tell you, I've definitely lost money on more individual stocks than I have made. One of my biggest losses I remember was probably Fleetwood.
Oh yeah,
and Magellan actually.
Oh wow, fund manager.
Yeah. Relatively, that was probably the last individual stock that I bought.
Never again.
And I thought Circle of Competence, funds management. I thought it was just after Hamish had exited.
Oh, okay.
And then it just kept on sliding, didn't it? They kept on seeing outflows and whatnot. And I thought, well, they will be able to steady the ship. And I remember a portfolio manager that I know really well, he said to me when I asked him about it, he didn't invest in Magellan. He said, mate, you only want to own fund managers as a list of businesses when they're raising money.
Yeah.
That is the only time you want to own fund managers.
Yeah.
Is when they're putting on money.
Yeah, that's it. It's true. But I mean, one of the big points of confusion when people log into Rask Invest is they see our updates and whatever, but they also see share reports alongside.
Yeah, Amazon was one of the latest ones.
Yeah. They'll see Commonwealth Bank was in there, Altium, Xero, all these tech companies. They'll see really high quality companies. There'll be more coming. And they go, what are these for? Because they click on them and they read them and they get this wonderful digest of the business and how it's growing and what it's doing. But at the bottom, there's no buy, there's no sell, there's no I think it's worth this much, you should buy it now kind of thing. There's no inference that should be made. And people get really confused and they wonder, what are they doing? Why is this here? And the answer is because for some people, they do have the time. They don't have the skills. They don't have enough curiosity to go out and do it in their own time. So we do it for them. And we don't do it as a way to say buy, hold, sell. What we try and do is remove that noise and say, just focus on the business. This is a wonderful business. And we're here to show you why it's a wonderful business. And that's exactly how I invest if I invest in satellite companies. I'm not trying to trade them. I'm just going to hold them because I think they're wonderful businesses. I think we mentioned in the first podcast, I'm actually teaching a value investing course this weekend, and I've done it numerous times before. I teach it and I still hold some individual stocks, but the reality is that that has shifted in a massive way, the way people should invest that way. And so people don't have the time, and even if they do, they often don't have enough curiosity to. The reason curiosity is in here, if I take Curtis's words out of his mouth, is that if you injure yourself financially, if you get it wrong, it can be demoralizing. And what gets you back on the horse is the curiosity to understand why you went wrong and to improve and have a growth mindset. And a lot of people don't have that. And so I find a lot of our community, particularly our older community, find a lot of purpose in share investing, understanding what companies are doing things. And we don't want to take that away from them. And so we want to make it a safe place where they can learn about the companies and ask our analysts questions and myself without the need to feel like it's like a broker report or something that they need to act on immediately. We want them to feel informed and to have that at their disposal, but not to be overly active with it. And that's a really key point. Finally, we've got investors do not need to choose between active or passive. This is the easiest one of the lot. You don't have to choose.
It's when it comes to investing, so many people will die on a hill.
Yep.
Like they'll be staunchly one thing or another. You can split your chips.
Yeah.
You know, giving a casino analogy, you can split your chips here. Like you can have your cake and eat it too.
Yep.
Really, you can, but as long as you're not gambling with the other half, you know, you're not. You do have a core. If you do have a core component that is backed and built on fundamental research, and is this well diversified portfolio. But don't gamble with the other component though. If you are taking an active approach, it's not play money. It's money that's going to benefit your family. It's money that you've worked long hours for. I do actually talk to people they have a small portion, they just call it their punt fund.
Yeah.
I have
fun money.
Yeah. Yeah. But it's money. It's your money. Do take it seriously.
Yeah. And I was just trying to find this Charlie Munger quote that I had say from poor Charlie's Almanac, which is appeal to interest, not to reason. And if you're looking to convince someone, appeal to what their interest is. Or if you're looking to understand someone, appeal to their interest. And when I say interest, I don't just mean like curiosity. What I mean is their self-interest. And a lot of what we hear in the media or see in the news from the financial news is someone espousing the virtues of their investment philosophy or investment strategy, as we have done here today, with a very clear intention that we want to convince you to invest with us. And one thing that we said on our live show the other day when you and I did one together for a small slither of our community, we said at the start of the show, we said, we want you to invest with us. We just flat out, we want you to invest with us, and you will hear us talk about that. And we're unashamed in that, but we're not right for everyone. But if what we're saying makes sense, come and invest with us. And it's as simple as that. And a lot of the times when you see active versus passive debates, you see small cap versus large cap, growth, value. It doesn't matter because you can do all of it and you should do all of it. And you shouldn't feel like because someone does something, you have to follow him or her into that. You can do what you think is best for you. And that's effectively why we've built the portfolios the way we have. Now, Mitch, we did promise each other that we would keep these episodes to around 35 minutes. Again, we've gone overdue. We've got one more left before then we'll have the finale, which is a live show that everyone who is on our mailing list will get notification to. You can create a free account.
Or go to the Rask community.
Yes,
the event
Rask
will be in the Rask community section where you'll be able to pop it in your calendar.
Yeah, just Google Rask community events and it pops up. Otherwise, just see the link in your show notes or below the video, and you can come and ask these questions. And what I would be particularly interested in is we've just talked about these 10 truths. Come and shoot us down. Come and tell me, stress test it. Tell me why you think it's wrong. I would love to engage in that respectful, wholehearted discussion. And that's the way we operate here. And that's the way I like to live. So bring it on. And also just bring on some of your concerns or your feedback or questions about long-term investing. We have one more episode for folks, and we're going to take the counterpoint in effect. We're going to talk about the things that no one really seems to talk about in investing.
The 5 things.
We've got 5 things.
You did put a definitive number against
it. I did put the number in the title. I think it's because we did 10 truths. We thought 5 things no one talks about, maybe to have a point of distinction. But we'll talk about them in the next episode. And so, Mitchell Sneddon, I really do appreciate you taking some time to join me for this episode.
Thank you, Owen. It's been great.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.